Are you thinking about buying a home in California or just curious? Will home prices in California keep rising in 2024, or are we on the verge of a significant market crash? Currently, homes in California are extremely pricey, reaching their all-time highest average of $746,000 in 2024. This makes California the most expensive housing market in the U.S., with prices more than 25% higher than the second-ranking Washington, D.C. The steep costs have triggered a notable migration trend, with a substantial number of people leaving California over the past 3 to 4 years. Cities like Los Angeles, San Diego, and the Bay Area have experienced an outbound migration, leading to a loss of 217,000 residents in the most recent year. While this is an improvement from the 2021 loss of 415,000, it remains one of the worst migration patterns in California's history, indicating a continuous population decline. Surprisingly, despite the significant migration losses, home prices in California have not seen a substantial drop. Although there was a slight dip in prices around the middle to end of 2022, especially in the Bay Area, prices have either rebounded or stabilized since then. The question arises, why are home prices staying high when so many people are leaving? The key factor contributing to this scenario is the low inventory of homes on the market. The number of homes for sale in California, especially in Southern California, remains significantly below the long-term average. Don't forget to subscribe. For example, in San Diego, there are currently only 2,600 homes for sale, well below the usual 4,400 homes. This limited inventory is constraining the market, leading to increased demand and, consequently, pushing home prices in San Diego up by 6% over the last year. Looking ahead to 2024, I'll provide projections for home prices in Orange County, San Diego, and other parts of California later in this video. Before delving into those specifics, it's crucial to understand a vital metric for potential home buyers and real estate investors. The overvaluation percentage helps gauge how overpriced homes are in a market compared to long-term norms. After the pandemic, home prices surged to record highs, often outpacing increases in incomes and wages. This rapid increase, surpassing income growth, is a sign of a housing bubble. To assess overvaluation, tools like the Reventure app analyze the home value-to-income ratio. In many areas of California, this ratio indicates overvaluation, some Northern California regions ranging from 30% to 40% overvalued. The home value-to-income ratio in these areas is higher than the long-term norm, suggesting a potential correction is needed for market equilibrium. While a 50% price drop like the one in 2008 is unlikely, there is a need for a balance. This implies that home prices may need to decrease, incomes increase, or a combination of both for the California housing market to find balance in the coming years. Despite high prices and ongoing increases in some areas, the actual demand in the market is currently low. The combination of exorbitant prices and mortgage rates nearing 7% has deterred many potential buyers, resulting in a 25% year-to-date decrease in home sales in California according to the late 2023 housing market update from the California Association of Realtors. This marks the lowest sales volume since 2007. Sales volume in California is currently at its lowest level since 2007, signaling potential challenges for the state's housing market. This decline doesn't indicate strong buyer demand but rather a lack of new listings. If listings were to increase in 2024 and 2025, perhaps due to financial stress among sellers, such as tech layoffs or rising unemployment, currently at 4.9%, one of the highest in the U.S., it could lead to more forced selling. This, in turn, would raise inventory levels at a time when home buyers in California may struggle to afford it. Exploring the Reventure app, we find that the typical monthly house payment for a new home buyer in California, considering current prices and mortgage rates, is $5,200. This is significantly higher than the national average of $2,880, making California the most expensive state for housing payments. For buyers in places like LA or San Diego, an annual housing payment of at least $60,000 implies a required income of $200,000 to $250,000 to qualify for a mortgage. This situation is viewed as unsustainable, raising concerns about the housing market's future. Differences in housing market trends exist not only between cities in California but within neighborhoods. Analyzing data on percentage changes from June 2022, certain areas in San Francisco, like Oakland and urban San Francisco, have seen home prices drop by 15% to 17%, while suburban locations like Concord and Pittsburgh only experienced a 7% decline. So, what's the takeaway? Before making any big moves in California's real estate game, do your homework. Check out the trends in your zip code. Look at how prices have been changing in your specific neighborhood over the past year and a half. And, just as important, see how much inventory is available. In the end, understanding these local differences is like having a secret weapon. It helps you make smarter decisions about when and where to buy or invest. So, whether you're eyeing a home in Anaheim, Los Angeles, or Palm Springs, remember to zoom in and pay attention to what's happening right where you want to make a move. It's the key to navigating California's housing market maze successfully. California has experienced ups and downs in its housing market over the years. Sometimes, the prices of homes drop a lot, causing challenges for homeowners. But here's the thing, California has a knack for bouncing back. Even though prices may go down for a while, they often go up again later. One big issue is that there's not enough building happening in California. This means there aren't enough new homes being made to keep up with the number of people who want to buy homes. So, we end up with a cycle, prices go up, then there's a drop, and then they go up again. This cycle is partly because there aren't enough new houses being built regularly. Looking ahead, we might see some corrections in the housing market over the next few years. Corrections are like adjustments, it could mean that prices might go down a bit. But the bigger picture is that, because there's not enough building happening, the prices might go up again in the long run. It's like a seesaw, it goes down, but it usually goes back up eventually. So, even though there might be some changes in the housing market, the overall outlook suggests that prices could go up again, mainly because there aren't enough new houses being built. If you'd like to continue exploring this world of finance, consider subscribing and inviting your friends to join the conversation. We're here to provide insights and knowledge. Check out this eye-opening video by clicking on the link if you want to know more.